We're forever being asked to give personalised investment advice. However, to give financial advice in the UK, a regulated financial advisor would have to conduct a detailed fact find to understand a person's income, debt, financial goals, assets, attitude to risk, and so on.
The regulation of financial advice in the UK has led to what is known as the advice gap. Low and even middle earners cannot afford to seek financial advice as the cost is too prohibitive.
It's a tragedy that so many people never get the proper help they need with managing their money. We truly believe that learning the money basics can be the difference between living a financially comfortable life and retiring wealthy, or struggling through life and retiring broke.
What we can do is break down what we would do, whether you're a complete newbie, intermediate, or expert. With this, we aim to serve you up a generic investment plan which works at your level of experience and resonates with you. Let's check it out.
Welcome to Unshackled.com, the investment and finance channel and website that says you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
And as always, don't forget to check out the Money Unshackled offers page where we bring you thousands of pounds of awesome offers. Many of the platforms and services mentioned in this video will reward you just for signing up. We'll link to that down in the description. It's worth checking out. Money basics. Firstly, let's quickly fly through the money basics that apply no matter your investing experience level. Get this nailed down and the investing part will be a doddle.
Number 1. Pay yourself first. Most people save whatever money is left at the end of a month, which in most cases is a big fat zero. Financial winners transfer into their investments straight away on payday, so you pay your future self first rather than spending it now on frivolities.
Number 2. Avoid expensive consumer debt. Avoid bad debt at all costs. Bad debts are those that drain your wealth and have no prospect of paying for themselves.
Number 3. Not all debt is bad. Good debt, on the other hand, is perfectly fine in our opinion, and we would pay it back as slowly as possible. An example of good debt is a mortgage on a property, or cheap debt used to secure a good long-term investment, which we'll cover at expert level.
Number 4. Cut down without cutting back. Pain-free savings can easily be achieved by just changing your providers, such as your car insurance, your house insurance, your gas, electricity, broadband, TV, gym, mortgage, other debts, and so on.
Woo!
All of these and many more can save you money, and yet will have little to no negative impact on your lifestyle.
Number 5. Savings buckets. Budgeting is tedious, but is essential for good money management. Many people's budgets fall down when it comes to annual or irregular expenses such as car maintenance. Be sure to put money aside for these before committing it to investments.
Number 6. Maximise income. If you want to increase the amount you invest, it can't all come from cutting down. You need to maximise your income. Real money is created by scaling your income, meaning you could be paid an unlimited amount of money for your work.
For example, photographers and videographers have taken and owned the footage seen in this very video. These stock images and video clips could be sold an infinite number of times and continually work for the owner. Therefore, their work is scalable. Truly understanding the difference between linear income, trading time for money, and scalable income will change how you approach earning money forever.
Investing tips for all. With the money basics mastered, you'll no doubt want to start investing for your future. That's awesome. Here's how we would invest by investor level, starting with
Noob, or lazy investor. One of the great things about technology is that it has made investing available for anyone, even to those who have no clue what it is that they are doing. Once upon a time, it was so expensive to invest that only the wealthy could access stock markets, and only they could afford to outsource their portfolios to expensive professionals.
We think it's best to be honest with yourself with how much you want to be involved with your investments. We half jokingly call this category lazy investors, but the reality is it is for the uninclined investor. It includes people that are too busy doing other stuff but understand that their money needs to be invested.
If you fall into this category, then we suggest checking out robo-investors such as Nutmeg, Wealthify and Money Farm. There are loads of robo platforms to choose from, but these are 3 of the biggest. And we have introductory offers for all 3 on our website, which we'll link to below. We've personally tested Nutmeg ourselves and really like what they have to offer, and any new customers who use the offer link get their first 6 months with no management fees.
On signing up, robo-investors will ask you a few questions and then allocate you to a suitable investment portfolio which they manage on your behalf. In this way, you're getting a tailored investment to your personal circumstances, but are only charged a tiny fee for the privilege. For instance, Nutmeg charge 0.45% for their fixed allocation product, which includes trading costs, and the funds within that portfolio have an average cost of 0.17%. This gives a total of just 0.62%.
Some investment commentators might argue against the need for robo-investing platforms when there are cheaper do-it-yourself alternatives. But they only say this because they know exactly how to invest themselves, enjoy it, and know how to manage all the risk that comes with it. It's the equivalent of a builder telling you to fit your own kitchen because they think it's easy. If you aren't comfortable or you don't have the time to invest, then we think that robo-investing platforms are worth their weight in gold.
Moreover, a lazy or uninclined investor doesn't have to be someone who knows little to nothing about investing. Someone who loves managing their day-to-day investments themselves might choose to outsource their pension to a robo-advisor.
After all, who can be bothered managing their pension? If you have never consolidated your pensions into a SIP, you should check out our recent video on why your workplace pension could be full of rubbish. We'll link to that video in the description for you to watch next.
Finally, you might want to start with robo-investing because you can learn how they build diversified portfolios. They will explain why they take certain actions and hold specific investments.
Intermediate or aspiring investor. For those who know the basics, enjoy it, and are comfortable investing themselves, then we suggest building your own world portfolio using ETFs. This strategy is likely to be the cheapest way to invest, as ETFs are generally dirt cheap in price. Our favourite low-cost ETF providers include iShares and Vanguard, followed by SPDR, L&G and Xtrackers. We personally target a world portfolio with about 6 key ETFs, with exposure to North America, Europe, UK, Japan, Asia Pacific and emerging markets.
Throw in some commodities like gold and bonds if you're that way inclined, and you'll soon have a well-diversified portfolio. If you're going to invest yourself, then you're going to need a do-it-yourself investing platform. I personally use Interactive Investor for my main investing account, which is best suited to those with large investment pots. We'll link to that down in the description below.
We both also regularly use free trade, which is great as there are no trading costs. Also, it is not prohibitive if you have a small pot, perfect for price-conscious investors. FYI, we personally don't invest in bonds, and instead get our interest fix from peer-to-peer lending, but interest rates are low at the moment.
The great thing at this level is that even an intermediate investor can quickly build up a really interesting and bespoke portfolio just by using ETFs covering all the main asset classes. If you want to invest in property, you can find a REIT ETF. With REIT meaning Real Estate Investment Trust, which invest in either commercial or in some cases residential property.
You can hold back the forces of inflation by investing in a basket of commodities via an ETF. One example is the iShares Diversified Commodity Swap ETF, which tracks the futures contracts on oil and gas, precious metals, industrial metals, livestock and agriculture for just a 0.19% ongoing charge.
Investing in regional ETFs like the Vanguard S&P 500 ETF will bag you hundreds of stocks. In this case, 500 of the biggest US companies in one purchase. If you want to control how much exposure you have to one country or region, or even to a market sector or industry, you can easily control this by buying more or less of a regional ETF.
We ran a series on this called the World Portfolio Playlist, which we'll link to in the description below. So you can watch that if you're interested in learning how to construct your own portfolio from regional ETFs.
Expert investor. For experts, or soon to be experts, we would invest in the same ETF investments that we just discussed and have this make up a core of a wider portfolio, perhaps between 50 and 70%. Then we would surround this with satellites, which could include rental property, individual stocks, and even speculative investments like crypto.
In terms of stocks, we would handpick individual stocks which we felt were poised to beat the market. This can be time consuming if done properly, and benefits from the use of a decent stock analysis package like Stockopedia, which is what we use, or from built up experience having started small for several months before committing any substantial money.
Individual stocks might make up 15% of your overall portfolio, but whatever split you go with should depend on your skills and commitment to stock picking. Investing in stocks is investing in publicly owned businesses, but you can also invest in privately owned businesses if you have the capital and expertise.
This might involve buying a chunk of a small business, but that needs a lot of capital behind you. A great way to invest in privately owned unlisted companies without being mega rich already is through an equity crowdfunding platform like Seedrs. which provides the opportunity to buy into startup businesses which are not yet floated on the stock market.
This is not for the faint-hearted, and you should do your own research first, which we've started for you in this video. The risk is perceived to be much higher than the stock market, but the returns are potentially higher too, making this an area worth checking out if you consider yourself to be an expert investor.
Skilled investors may also build their own assets. I own several rental properties, each of which I bought, refurbed and let out to tenants. A couple I even transformed into HMOs, installing extra bathrooms and transforming bedroom and living spaces to meet safety laws for housing multiple individuals within the one property. This netted around 30% annual profit per house, but again is not for the inexperienced.
This style of investing is very hands-on initially, and many regulations need to be adhered to, and quite rightly too, as you are responsible for people, not just paper assets. It can get more passive after that though if you hand over to an agent, as we would recommend if you value your sanity.
Whether it's stocks, property, or more exotic assets like equity crowdfunding, don't go too heavy on these asset classes unless you really know what you're doing. But you have to start somewhere, and learning by doing with small sums of money is the only real way to learn. Whatever your skill level, we think it's always important to diversify.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.